Hello there. So this is for the subject monetary policy and central banking. The topic for this one is monetary policy, stabilizing prices and output. Essentially the purpose of monetary policy. So we have here an article from IMF.org. IMF stands for International Monetary Fund, which is an international financial institution. Okay. Monetary policy, let's read the article, has lived under many guises, but however it may appear, it generally boils down to adjusting the supply of money in the economy to achieve some combination of inflation and output stabilization. So monetary policy, what it normally does is to control, it monitors and then control the supply of money in the economy. So depending on the economic situation, it can be increased and decreased through their, they have monetary policy tools that they use. And then they do that so that, they can curb inflation, make sure that it's at an acceptable level. It doesn't, go too high. And then that would also contribute to what we call price stability and, currency stability. And then there's also the output stabilization. Output would refer to the production of goods and services. Essentially, the supply of money in the economy aims to, to be used by businesses to stimulate economic transactions, and essentially, the production of goods and services, the output. And then on the side, through those economic activities, it also aims to provide employment opportunities. So we have workers and employees essentially contributing to high employment rate. Okay, that's another purpose of having the monetary policy. Okay, most economies would agree that in the long run, output, usually measured by gross domestic product, also the measurement of economic growth, is fixed. Okay, so any changes in the money supply only cause prices to change, but in the short run, because prices and wages usually do not adjust immediately, changes in the money supply can affect the actual production of goods and services. Normally, when you increase the money supply, it's supposed to stimulate more economic activities. But if it does not, normally it does that, but sometimes it would also result to increased prices of goods and services. So that would, lead to inflation, and inflation would then lead to lowered purchasing power of money, in which case, the value of money deteriorates because you would need more money to purchase something. And so that is somehow how do you call that? It's countering the supposed aim of increasing the money supply. Okay. Continuing on, this is why monetary policy generally conducted by central banks such as the U.S. Federal Reserve or the European Central Bank. Here in the Philippines, we have the Bangko Sentral ng Pilipinas. The monetary policy is a meaningful policy tool for achieving both inflation and growth objectives. Okay, going back, it was mentioned here, prices and wages usually do not adjust immediately because when the central bank infuses money into the market, it is still in the hands of, the first instance. Let's say they what do you call this? They bought government bonds from private banks. So the money after that certain transaction, it is infused in the economy, but it's still in the hands of the private banks, and it would take some time before the money gets into the hands of ordinary people like us, the household, the individuals, the workers. So it would take time before the prices adjust and the wages as well, before they would realize that, oh, there's an infusion of money. So, with that high supply of money, you can increase prices for goods and services. But again, it would take some time because, from the central bank to the private banks to the hands of the businesses, the borrowers, individuals and businesses, and then from them to their employees and the households, essentially. Okay. Continuing on, in a recession, for example, consumers stop spending as much as they used to. So, essentially, what we're experiencing in a recession is that, currently we're in a recession, technically. There is not much economic activities because of the various lockdowns. There are many businesses that aren't operating, and there are also many businesses that are operating on limited capacity, so they aren't producing as much as they can, and they are also not generating income as much as they could, right? And so we're in a recession. As for the people, because the businesses are on hold, some businesses are not operating at full capacity, then the people who are trying to earn money through employment, they are also unable to work properly. Their employment is not sure. Their work schedule, sometimes when the government announces a lockdown in certain areas, their source of funds, their livelihood, their employment is also on hold, so they don't have the money. So during recession, consumers stop spending as much as they used to for fear that they would run out of money. So normally, during this time, people are not sure when they're going to remain in service, or when their employers would continue to operate. So there's that fear. So somehow they're starting to save some money, so that in case the business stops operating and they found themselves without employment, then they would have money on hand to use for the transition, for looking for a new job, something like that. Okay. So during this time, many people are really not spending as much as they used to. Okay. And then other than that, of course, business production declines, leading firms to lay off workers and stop investing in new capacity. Essentially, that's what the situation is currently. Foreign appetite for the country's exports may also fall, and as you've seen, there are a lot of articles almost monthly that what they call it, hot money, foreign investors' money leave the Philippines on a monthly basis or quarterly basis, and so that affects the economic situation of the country. Okay. There is a decline in overall or aggregate demand, to which government can respond with a policy that leans against the direction in which the economy is headed. Monetary policy is often that counter-cyclical tool of choice. Okay, but given the current situation, there's not much that the government can do. What they're going to try to do is, simply to slow down the negative effects or the negative impact of the pandemic in the economy. But they're not actually going to, let the businesses operate as they do or as they did before the pandemic, because that could not be done at the current moment, because of the current situation. Okay, but still they're trying to lessen the negative effects by certain they do implement certain regulations. They decide to open certain industries. They allow certain industries to continue operating even at full capacity. Okay, things like that. Okay, such a counter-cyclical policy would lead to the desired expansion of output and employment. Normally, an increase in output would also translate to having more employment or higher employment rate. Okay, because you need more workers for the businesses to produce more output, goods or services. But because it entails an increase in the money supply, would also result in an increase in prices. Okay, so normally when there is an economic growth, an increase in GDP, there is that notion that there is an increase in money supply. Okay, because of course the central bank would have to react to the increase in GDP, so they would infuse money into the economy, and that would result to an increase in prices. Okay, but how do we? In a way, what do you call this? The central bank, the monetary board, would still have to ensure that the infusion of money in the economy is on a gradual basis, because essentially GDP, the whole point is to increase the GDP, because that's the measure of economic growth, and the better it is, the more the more attractive the Philippines is for foreign investments or any types of investment, local, domestic, or international foreign investments. Okay, but in a way, they do it normally on a gradual basis, and again, not abruptly, so that they could monitor the effect on the prices, the inflation, and whenever the inflation rate breaches the acceptable level, then normally they would slow down with the money infusion, and sometimes they would slowly counteract by retracting some of the money supply. Okay. As an economy gets closer to producing at full capacity, increasing demand will put pressure on input costs, including wages. Workers then use their increased income to buy more goods and services, further bidding up prices and wages and pushing generalized inflation upward, an outcome policymakers usually want to avoid. Okay. In a previous video, I think I'd mentioned this, that normally, again, workers, if what do you call this? Okay, so in the market, there is already a somewhat increase in prices, the prices of goods and services, and so the workers, the employees, would tend to request for the wage boards to increase the minimum wage, so that the companies would also increase, of course, the compensation of these individuals. But it's not easily done because, on the economic side, we know eventually what's going to happen is that when you increase the minimum wage, so, businesses, people would know that there would be an increase in money supply, or there's an increase in the money that's available for people to use, and with that, it could drive prices much higher. There's going to be an increase in prices of the commodities, the basic necessities as well. And on the part of the businesses that are going to have to pay the compensation, right, they're going to have additional cost for the increase in wages if ever that's implemented. And for them to compensate for the increase in the wages of the employees, then they would have to increase the prices of their goods or services to cover up the cost that they have given as compensation to the workers. So essentially, more or less, the purchasing power of the increase in the wages, it's the same, right? Because even if you have an increase of, let's say, 1,000 a month on your salary or wage, but then you realize that the increase in the prices of goods and services is just almost the same, the increase that you get, you realize that even with your new salary rate, you're only able to buy the same amount of goods and services even before the increase in your salary. So in that case, what's the point of increasing your salary if the overall effect on the purchasing power is, nothing? There's essentially no increase in the purchasing power of your money. Okay, so that is that. There is that. Okay. Going back to objectives, the monetary policymaker then must balance price and output objectives. Okay. Price stability and then increasing the output. Indeed, even central banks that target only inflation would generally admit that they also pay attention to stabilizing output and keeping the economy near full employment. Because, as much as possible, we want to provide employment to the residents, the citizens of the country. Okay. And essentially, the output is supposed to supply the needs and wants of the consumers. Okay. And at the Fed, which has an explicit dual mandate from the US Congress, the employment goal is formally recognized and placed on an equal footing with the inflation goal. Okay. Normally, when we talk about monetary policy, the main point, of course, is price stability. Okay, and to curb the inflation. And although there is that goal as well to increase output and to provide higher employment rate, That's not normally discussed at length, and so certain countries they are given separate mandates, or they are given clear mandates on that. Okay. Monetary policy is not the only tool for managing aggregate demand for goods and services. There is the fiscal policy, which is about the taxing, imposition of taxes, tax laws, and spending of the government. Okay, governments have used it extensively during the recent global crisis. However, it typically takes time to legislate tax and spending changes. Normally, before you introduce a tax law, that would affect majority of the taxpayers. It would need quite some time because you need to whoever is proposing such a bill would need to provide studies on how it's going to affect the economy as a whole, how it's going to affect the businesses, the individuals, and how much it's going to benefit the national on the national level. Okay, so it would need some time for them to properly assess and study the effects that it's going to have, and so it would take some time. Like sometimes it would take 1 year, 2 years, 3 years before these are properly discussed, and of course there's also public consultation before, and then there will be a lot of discussion in the Congress and in the Senate before they pass it into law and for the president's approval. Of course, BICAM before the president's approval. Okay. And spending changes. We know that we have the national budget, and so it would depend if. That's why, for the next year, they're already preparing the budget. I think mid-year, for example, 2021, by June or July, they should be able to pass the national budget for 2022. And so if the government would like to change their spending goals or objectives, then it would take at least that much, half a year before they're able to implement such changes. And of course, it would also be tied on the collection of the revenues, because 2022, although it's already January, the national budget has been approved 2021, but they don't have the cash yet because it's still collectible from the taxpayers. Or if sometimes they would borrow from financial institutions so that they could have the money on hand already, and they would not have to wait for the collection of the taxes and the revenues. Okay, but it would still take some time, right? Even when they borrow from financial institutions, it would take some time. And once such changes have become law, they are politically difficult to reverse. Okay, especially tax laws. Okay, let's say they implemented it and then they realize it's having negative impact on the economy, something that they have not considered before, which is going to be very stupid, to be honest, because they are lawmakers, right? Normally it wouldn't happen. That's why they're taking a long time before they pass such laws, because when it's already implemented, approved as a law, it would be very difficult to retract those laws, because it's like admitting, yeah, we messed up, okay, we were wrong, all right? So it would be hard to reverse. Okay, and they would have to file a separate bill retracting it, or what do you call that? Stopping or ceasing the implementation of such law. Okay. Add to that the concerns that consumers may not respond in the intended way to fiscal stimulus. For example, they may save rather than spend a tax cut. Okay. There is that. And it is easy to understand why monetary policy is generally viewed as the first line of defense in stabilizing the economy during a downturn. The exception is in countries with a fixed exchange rate, where monetary policy is completely tied to the exchange rate objective. Philippines is not like this, okay? We don't have a fixed exchange rate. It will depend on, supply and demand. Okay, let's go back here. They may save rather than spend a tax cut. When a person has money, if it's going to be saved at home, in a coin bank, in a piggy bank, or between the pages of a book, essentially that money, that's part of the supply in circulation. But if it's stuck in the household, then it would not in any way contribute to the economy, right? So if you would rather save your money, it's best to put it in the bank so that the bank or any financial institution would be able to lend it to businesses or to people who would spend it, because it is in the spending that the economy grows, okay? So that the businesses and the individuals could use it to, further their operations or to use it in whatever needs that they have, okay? So we need to continue or to ensure that the money is being used for economic activities, okay? So don't save your money in piggy banks or at home, okay? If you want to save money, save them in the bank. Alright, independent policy. Although it is one of the government's most important economic tools, most economists think monetary policy is best conducted by a central bank. Yes, here in the Philippines, we have the central bank, the monetary board, that is independent of the elected government, although ours are appointed by the President of the Philippines. But essentially, the picture is that whatever the monetary board finds that the economy needs, then if the president or whoever in the government wants a particular thing to be done, but if the monetary board deems it to be negatively impact the economy, then they're not supposed to listen. Okay, so essentially there should be independence, is what they're trying to say. Okay, although they are tied to the government, but action-wise or responsibility-wise, or when it comes to making decisions, they should be independent from the government. This belief stems from academic research some 30 years ago that emphasized the problem of time inconsistency. Monetary policymakers who were less independent of the government would find it in their interest to promise low inflation to keep down inflation expectations among consumers and businesses. But later, in response to subsequent developments, they might find it hard to resist expanding the money supply, delivering an inflation surprise. Okay? That surprise would at first boost output by making labor relatively cheap, wages change slowly, and would also reduce the real or inflation-adjusted value of government debt. Okay? But people would soon recognize this inflation bias and how do you pronounce it? Up their expectations of price increases, making it difficult for policymakers ever to achieve low inflation. Okay? To overcome the problem of time inconsistency, some economists suggested that policymakers should commit to a rule that removes full discretion in adjusting monetary policy. Full discretion. In practice, though, committing credibly to a possibly complicated rule proved difficult. An alternative solution, which would still shield the process from politics and strengthen the public's confidence in the authorities' commitment to low inflation, was to delegate monetary policy to an independent central bank that was insulated from much of the political process, as was the case already in a number of economies. The evidence suggests that central bank independence is indeed associated with lower and more stable inflation. Okay. Conducting monetary policy. How does a central bank go about changing monetary policy? So, basic approach is simply to change the size of the money supply, either increase or decrease depending on what the economy needs. This is usually done through open market operations, in which short-term government bond debt is exchanged with private sector, or normally government bonds. Okay. So essentially, it's, buying or selling the government bond. So if they needed to infuse money into the market, then they would buy government bonds, because when they buy, they would pay the money goes into the market. But if they needed to decrease the money supply, then they would sell government bonds. Okay, when they sell, they receive the money, so the money goes from the market to the central bank. Okay. So in that case, they can control the money supply. And then, where are we? In the Fed, for example, buys or borrows treasury bills from commercial banks. The central bank will add cash to the accounts called reserves that banks are required to keep. Okay, that expands the money supply. Okay. There's also the BSP, Central Bank Monetary Board. They also impose regulations upon banks and financial institutions, right? And especially banks, they are required to keep a certain amount of money in their reserves. They're not allowed to lend this money to the public. For example, 20% reserve requirement. So they have to keep the 20% on hand or in the reserves of central bank, and then only 80% is allowed to be lent to borrowers, businesses, and individuals. Okay, but if the central bank wants to decrease the reserve requirement, so let's say from 20% they make it 10%, so the bank can lend the 10%, okay, because from 20 it becomes 10, so they can lend the 10%, and lending that to the public would increase the money supply in the economy, right? And then on the reverse side, vice versa, the central bank can also increase the reserve requirement, let's say from 20% to 30%. So in that case, the banks, they would be not exactly forced, but they would have to abide by the regulation. So they would increase the reserve requirement, so the money would be taken from the market and into the reserves of the bank. So in that case, there would be a decrease in the money supply. Okay, so there are things like that. Okay, while many central banks have experimented over the years with explicit targets for money growth, such targets have become much less common because the correlation between money and prices is harder to gauge than it once was, because there are many factors to consider. Many central banks have switched to inflation as their target. BSP is also using that inflation targeting, either alone or with a possibly implicit goal for growth and or employment. Okay, when a central bank speaks publicly about monetary policy, although BSP do release I think monthly reports, quarterly reports in their website, it usually focuses on the interest rates it would like to see rather than on any specific amount of money. Yes, although the desired interest rates may need to be achieved through changes in the money supply. Although normally it's changing the interest rates that would change the money supply, right? Central banks tend to focus on one policy rate, generally a short-term, often overnight, rate that banks charge one another to borrow banks. Okay, when the central bank puts money into the system by buying or borrowing securities, colloquially called loosening policy, increasing the money supply, the interest rate declines. It usually rises when the central bank tightens by soaking up reserves or retracting the money from the market into their reserves. The central bank expects that changes in the policy rate will feed through all the other interest rates that are relevant to the economy. Okay, so essentially it would take time for the effect to be seen whenever changes is being made. Transmission mechanisms. Changing monetary policy has important effects on aggregate demand and thus on both output and prices. There are a number of ways in which policy actions get transmitted to the real economy. So the one people traditionally focus on is the interest rate channel. If the central bank tightens, for example, borrowing costs rise. Okay, because borrowing costs, interest rates, if you borrow money from the bank and the interest rate increases, okay, you would be discouraged to borrow because you would be paying more interest, right? Because the interest rate increased. Okay, consumers are less likely to buy things they would normally finance, such as houses or cars, instead of going ahead with a housing loan or a car loan because the interest rates went up. You would be discouraged, maybe postpone it some other time. And businesses are less likely to invest in new equipment, software, or buildings. This reduced level of economic activity would be consistent with lower inflation because lower demand usually means lower prices, right? But this is not the end of the story. A rise in interest rates also tends to reduce the net worth of businesses and individuals, essentially because, they have less funds. The so-called balance sheet channel, making it tougher for them to qualify for loans at any interest rate, thus reducing spending and price pressures. A rate hike also makes banks less profitable in general, because there would be less borrowers and banks profit from the interest rate, okay, and thus less willing to lend. Okay, the bank lending channel, high rates normally lead to an appreciation of the currency as foreign investors seek higher returns and increase their demand for the currency. Okay, on the other hand, so there would be more people who would invest because, the interest rates are higher. They would be more willing to lend their money or put their money in the bank so that they could lend more and then they could get higher returns. Okay, but then there's the issue of the demand, because the demand would go down. Through the exchange rate channel, exports are reduced as they become more expensive and imports rise as they become cheaper. In turn, GDP shrinks. Okay. In this scenario, then of course, because people are discouraged from spending, so the GDP will definitely shrink. Okay, or they would not be able to achieve the targeted GDP. Monetary policy has an important additional effect on inflation through expectations, the self-fulfilling component of inflation. Many wage and price contracts are agreed to in advance based on projections of inflation. If policymakers hike interest rates and communicate that further hikes are coming, this may convince the public that policymakers are serious about keeping inflation under control. I think, in the last year since the pandemic started and a lot of businesses were closed down or temporarily ceased their operations, I think the BSP did provide a lot of reports or updates on how they're going to respond to that scenario. Because also foreign investors are pulling out their investments because of the less economic activities. Okay, long-term contracts will then build in more modest wage and price increases over time, which in turn will keep actual inflation low. When rates can go no lower. So after the onset of the global financial crisis in 2008, central banks worldwide cut policy rates sharply, in some cases to zero, and then in other cases, I think Japan, negative interest, in which the borrowers are being paid extra money just for them to borrow from the banks, exhausting the potential for cuts. Nonetheless, they have found unconventional ways to continue easing policy. One approach has been to purchase large quantities of financial instruments from the market. This so-called quantitative easing increases the size of the central bank's balance sheet and injects new cash into the economy. Okay. Banks get additional reserves, the deposits they maintain at the central bank, and the money supply grows. A closely related option, credit easing, may also expand the size of the central bank's balance sheet, but the focus is more on the composition of the balance sheet, that is, the types of assets acquired. During the recent crisis, many specific credit markets became blocked, and the result was that the interest rate channel did not work. Central banks responded by targeting those problem markets directly. So for instance, the Fed set up a special facility to buy commercial paper, very short-term corporate debt, to ensure that businesses had continued access to working capital. It also brought mortgage-backed securities to sustain housing finance. Okay. So another thing that happened during the 2008 financial crisis, is that some companies are considered too big to fail, in which case, closing them would have a large impact on the economy, and so the government was, in a way, forced to save them by providing them with, financial help, right? Some argue that credit easing moves monetary policy too close to industrial policy, with the central bank ensuring the flow of finance to particular parts of the market. But quantitative easing is no less controversial. It entails purchasing a more neutral asset like government debt. Normally, it's the government bonds, right? But it moves the central bank toward financing the government's fiscal deficit, possibly calling its independence into question. Yes. Supposedly, monetary policy and fiscal policy works together. Normally, it's the monetary policy first, but if it's not enough, then the fiscal policy also has to be, executed or implemented. Okay, but essentially they have the same goal: to curb inflation, to stimulate economic activity, to increase employment rate, price stability, things like that. Okay. Alright, so that's it for this one. Essentially, we've discussed the monetary policy, mainly the purpose, which is stabilizing prices and output. Alright, so that's it for this one. Thanks and bye.